Australia's central bank has surprised markets with a larger than expected hike in its benchmark interest rate. The adjustment of half a percentage point is the largest in more than 2 decades. And it's a sign that officials there are growing increasingly concerned over consumer prices, which rose more than 5% in the first quarter. Rates set by monetary authorities influence the amount of money charged by banks for home loans, credit cards, and other types of debt. That means any increase tends to slow down consumer and corporate spending as a way of stabilizing inflation. Meanwhile, in China, economic engines are once again starting to fire on all cylinders. Officials and private sector estimates show imports and exports rose in May. That's after the easing of lockdowns that's allowed factories to reopen. Businesses there also say they're receiving plenty of government support.
We have received strong support from the government. So far, our production has recovered quickly. Our workers came to their posts on the morning of June 1, and by the night shift that day, we had recovered 100%.
Now, for more on the story, let's go to Naeem Aslam, Chief Market Analyst at AvaTrade in London. Welcome back to the program, Naeem. Now, most governments in major economies now united in raising interest rates. Can you describe how big of a threat is rising inflation to economic stability in major economies, and to what extent will monetary policies be effective in bringing down prices?
Thank you for having me as always. I think central banks are desperate to bring inflation closer to its normal level. However, I think the task is incredibly cumbersome, and maybe they will be able to bring inflation down, but not anytime soon. Now, higher interest rates, what they're doing is they are slowing economic growth, because if you look at economic data, it continues to paste a very, very pessimistic picture. And that is very much reflected in the stock market as well, because we don't see any major upward trend emerging. Traders are continuing to look or fish for a bottom, which doesn't seem to be anywhere in sight. So I think that because of soaring inflation, slow economic growth, we don't really think that markets are really going to have any major trend, and central banks are not going to be able to bring inflation lower anytime soon.
So what can governments do to ease the growing burden on consumers without sacrificing economic activity?
You see, this is a very interesting question, because governments have a very limited choice, because if they continue to let inflation run at a pace where it is, it's going to be even more disaster for economic growth. So hence what they are doing is that they're trying to increase interest rate in a more gradual manner, and that is the only thing that they can really do. The other thing that central banks can do is, of course, use language to control inflation, but at the same time, pay very close attention to economic data, because if economic data begins to point out that recession is on the doorstep, then they will have no other choice but to reverse their monetary policy again, which will be considered as a huge another monetary policy mistake by the central banks.
All right, Naeem Aslam joining us from London. Thank you for joining the show as always.